I'd now like to invite on stage our keynote speaker for the evening. Everyone's excited to listen to him speak, a man who's been a keen observer of the Indian economy for many years now, and he's been investing in global emerging markets for over 40 years and has won not only multiple awards but multiple nicknames as well. He's known to many as the father of the emerging market funds, or to some as the Pied Piper of emerging markets. He's here to share his views on the India story. Ladies and gentlemen, please welcome the Executive Chairman, Templeton Emerging Markets Group, Franklin Templeton Investments, Dr. Mark Mobius.
Let me now talk to you about India and China. And you said that over the next 20-year period, you actually see India outperforming China. What are you basing that assumption on? You also had a slide up there where you showed that there has been policy paralysis, at least legislative paralysis over the last several years. What are you basing your assumptions on at this point in time for why India will outperform China?
Well, a number of reasons. First of all, India is starting from a low base, a much lower base than China. So the percentage increases are easier from a low base. This is the problem that China is facing. It's still such a huge economy, very difficult for big increases. That's number one. Number two, the cell phone, the smartphone, is pushing government in India to move faster, because people now know what's going on. They have a very good idea of any problems, and they're able to demonstrate very quickly to the government that they're happy or unhappy. So this feedback mechanism is having a very big impact on India. And India is different in the sense from China, in the sense that China is a planned economy. The government, of course, tries to do the best for the people, but it's a top-down approach. In India, the central government may think that it has a top-down approach, but it doesn't. It must rely on the incentives of the population of the various states. And now the environment is very conducive to change at that level because of this communications revolution that we're seeing. So that's another reason why we see India moving very quickly. The other thing is that India, of course, has many languages. But there is a very great knowledge of English. And that's put India in a position to move out into other parts of the world, not only to gather intelligence, but also to move some of the services and products into the world. And that means better exports going forward. So I would say those are the, and of course, another argument is the population. You've got a very young population. The young population tend to be more productive as they move into the older years. And particularly now, with the knowledge revolution based on the internet, that is going to have a tremendous impact on India.
As you look at your dashboard today, what would be the key risks, not just facing emerging markets in general, but India in specific? And I ask you this in the context of the windfall gains that India is enjoying today on account of crude prices coming off as sharply as they have. Do you believe that we are going to see an upturn as far as the commodity cycle is concerned? And if that is indeed the case as early as 2016, in the short term, what is that going to mean then for India?
I believe that eventually, maybe as early as next year, commodity prices will begin to recover. It will not be a rapid recovery, but you're going to see a bottoming out, let's put it that way. Because we're now in a position where supply-demand will require more supply, number one. And number two, because in all these commodities, demand continues to rise. It's not a matter of demand going down. It's just that supply has more than kept up with that. So I believe this will take place. But now, because of the previous high prices for energy and some of the other commodities, replacements have come into line. Now, this replacement phenomenon, for example, in energy, solar, wind, has not been as economic as it would have had if prices were very high. As prices rise, these alternatives will come into play. And that will put a damper on the impact, the negative impact it could have on India going forward. So I'm not too worried about a rise in commodity prices.
Would you say that the threat of a Fed rate hike and then the possibility or the consequence of outflows from emerging markets like India, the worries and the concerns overdone, exaggerated at this point in time, or do you believe that that is a real concern?
It's definitely overdone. The anticipation of a Fed rate hike has gone too far in terms of the fear that it has gendered among people around the world. I believe that if the Fed, or when the Fed raises rates...
Do you see December?
I said in the middle of this year that there was a good chance they wouldn't raise rates at all. Because if you're sitting in a central bank, what's the reason for you to raise rates other than inflation? Where is inflation? We're almost in a deflationary environment because of the internet, because of all these technological advances. So I think it's going to be very difficult for them to make dramatic moves and a lot of that has been discounted already. So once it happens, then people can say, okay, now we've seen it happen, we had accounted for it, what's next? And then you're going to see a recovery, and you're not going to see so much fear about rate hikes.
So what would be the triggers as far as fund flows into emerging markets are concerned? Because even at 4%, as you pointed out, which is the outlook that the IMF has for emerging markets, we're still doing better than developed markets. As per your slide, valuations are not looking particularly stretched at this point in time. What would be the triggers then for fund flows into emerging markets?
One trigger, of course, is the announcement by the Fed. Because right now, the uncertainty is what's killing the markets, generally speaking. People are just afraid to do anything. They're moving money into U.S. dollars, and they're waiting. Once that takes place, then you will see money flowing back in, I believe. And that would be one trigger. The other trigger will be the realization that these countries are still growing at a tremendous pace. So you're going to see reason coming into play again.
You know, a conversation that I was having a couple of weeks ago with another emerging market specialist, of course, doesn't have the 40 years or 40 plus years that you have tracking emerging markets. But he said something interesting. He said there's always been a prejudice, and there continues to be a prejudice about investing in emerging markets. Do you agree with that?
Oh, definitely. I mean, there's always been a fear of emerging markets because the general image is usually not good. I mean, they think that emerging market countries are problems, they have various economic, social problems. So the general attitude is that this is risk. And you must remember that from the very beginning, the biggest investors in emerging markets were U.S. investors. And if you know anything about the U.S., you know that for the most part, the U.S. is very provincial. They don't look beyond their borders very easily. Then you had the Europeans come in. They're more open-minded. They know there are different countries around the world. They know where India is, and so forth and so on. So they began to move out. But now we're getting a situation where the emerging market countries themselves are beginning to invest in emerging markets. Domestic investors are getting bigger. And you're seeing a rise of sovereign wealth funds in emerging markets. So that's changing the nature of emerging markets investing. And that, of course, is a very good thing. So going forward, we believe that that will be resulting in a less volatile flow of funds. Right now, of course, everybody is looking at U.S. dollars and trying to get into the U.S. But once that is over, I think you're going to see a much more diversified investor base.
So besides India and China, what are the other emerging markets that you would bet on today?
India, China.
India number one?
India number one, probably. But of course, if you look at our portfolios, you'll see that China is bigger because the market capitalization is bigger and there's more things to choose. Then if you look at Vietnam, that would be the next interesting area.
Okay, so Vietnam at number 3. Do you have a top 5?
Brazil has got to be of interest because prices have come down so dramatically. So that would be interesting. And Russia. You saw on the chart, Russia and India have underperformed. Those two, if the sanctions are lifted in Russia, that could be a real winner.
Mm-hmm. In terms of geopolitical risks and threats, how much is that coloring the fund flow at this point in time?
It colors it very much because people read the newspapers, they see what's happening in Europe with Ukraine, they see what's happening in Brazil, and they are affected. Their thinking is affected on how they will invest. There's no question about that.
As far as India is concerned, and you spoke about some disappointment over the pace of reforms, whether the Prime Minister has been able to deliver on the promise that he held out when they came to office and so on and so forth. You know, as a long-term India watcher, as a long-term India investor, how would you truly assess the performance over the last 18 months?
Over the last 18 months,
of this government?
I think it's been outstanding when you look at it. I mean, if you look at emerging markets generally, India has been a standout in terms of performance. Performance has not been that great, but it's been a heck of a lot better than all the other markets, almost without exception.